Welcome to The Explainer. Today, we are unpacking a massive structural earthquake that's hitting digital media giant Ziff Davis in early 2026. Now, if you follow the digital media and tech space, you already know Ziff Davis is an absolute powerhouse. They operate a huge portfolio of brands across tech, shopping, gaming, and health. But right now, they're undergoing a radical transformation. So today, we're going to use their Q1 2026 financial results, which are hot off the press, alongside some crucial SEC filings to visually break down exactly how this media conglomerate is reshaping its entire future. Let's dive in.
We've got to start right here with the headline number, $1.2 billion. That is the staggering amount of cash Ziff Davis is securing from selling its connectivity division over to Accenture. This isn't just some routine corporate restructuring. This is a monumental divestiture that literally alters the DNA of the whole company. It's an enormous cash infusion that's about to give Ziff Davis one of the most formidable war chests in the entire digital media landscape.
CEO Vivek Shah really hit the nail on the head here when he said, "We remain focused on unlocking value for our shareholders as we look to complete the divestiture of the connectivity business as well as explore additional value-creating transactions." This sets the central thesis for what we're looking at today, shrinking to grow. By cutting off a large, valuable arm of the business, they are unlocking immense shareholder value and positioning themselves perfectly for their next major strategic play.
Here is our roadmap for today. We're going to hit the billion-dollar sale, check out their Q1 2026 financial snapshot, dive into the core business portfolio, look at cash, debt, and buybacks, and then wrap it all up with the Wall Street forecast.
All right, let's jump straight into Section 1, the billion-dollar sale.
So, on March 2nd, 2026, Ziff Davis entered into a definitive securities purchase agreement with Accenture. They agreed to sell their entire connectivity division for an aggregate purchase price of $1.2 billion in cash. Now, to put that into perspective, this division was generating over $57 million in revenue just in the second quarter of the previous year. It was a highly profitable, high-performing segment. So selling it off to Accenture isn't a fire sale by any means. It's a highly strategic monetization event designed to completely reset Ziff Davis's balance sheet and operational focus.
Moving on to Section 2, the Q1 2026 financial snapshot.
Before we look at the raw numbers, there's a really crucial accounting rule we need to understand so the math actually makes sense. When a company agrees to sell a major division, accountants essentially quarantine those numbers. So in the Q1 2026 earnings report, Ziff Davis split their financials into two separate buckets. You have continuing operations, which is the new core business they're keeping, and discontinued operations, which represents the connectivity business being sold to Accenture. From here on out, the revenue and profit numbers we're looking at reflect only those continuing operations.
So looking strictly at those continuing operations, here's the year-over-year comparison. Revenues dipped just a bit from $272.8 million in Q1 2025 to $267.6 million in Q1 2026. That's only about a 1.9% decrease. Adjusted EBITDA, which, as you know, is a great measure of the company's core operational profitability, also saw a contraction, moving from $71.4 million down to $63.4 million. The crucial takeaway here is this. We're looking at a company in a state of transition. They're managing through some macroeconomic headwinds that are challenging parts of their portfolio, which the CEO actually noted. So this isn't a panic scenario. It's just a recalibration phase while they await the closing of that mega deal.
That brings us to Section 3, the core business portfolio. As you can see, the new streamlined Ziff Davis is built on four distinct pillars. For Q1 2026, health and wellness is actually leading the pack, pulling in nearly $86 million for the quarter. Technology and shopping follows right behind at just over $71 million. Cybersecurity and MarTech brought in roughly $70 million, and gaming and entertainment rounded the whole thing out at nearly $41 million. What you're seeing here is a highly diversified, vertically focused digital media engine that absolutely no longer relies on just a single dominant segment.
This breakdown brilliantly illustrates the underlying profitability of these individual segments. Pay special attention to that operating income line. While technology and shopping posted an operating loss for the quarter, gaming and entertainment posted a solid $7.8 million in operating income, and that's despite having the lowest total revenue of the four groups. Health and wellness and cybersecurity and MarTech also posted really strong positive operating incomes of $8.6 million and $13.6 million respectively. This absolutely proves that beneath the top-line revenue transition, the core engines of Ziff Davis are still generating real operational cash.
All right, let's look at Section 4, cash, debt, and buybacks.
If you're wondering how management is treating the balance sheet right now, the answer is
They are aggressively rewarding shareholders. In Q1 2026 alone, Ziff Davis deployed $51.6 million towards share repurchases. Look, when a CEO says they're focused on unlocking value for shareholders, we all know talk is cheap. But spending over $50 million in a single quarter to buy back your own stock, that is direct, undeniable proof that management believes their stock is undervalued, and they are fully willing to put their capital on the line to prove it. Now let's look at the debt stack, because leverage is always the boogeyman during corporate transitions, right? Ziff Davis currently carries about $872 million in gross debt. On paper, sure, that sounds heavy, but when you factor in the cash they already have sitting in the bank, that number drops significantly to a net debt of $352 million. And if you go a step further and subtract their long-term investments, the effective debt drops down to just $252 million.
This snapshot totally validates their exact capital structure. They are managing this transition with a very, very healthy balance sheet. And remember, this structure is exactly what it looks like before the $1.2 billion check from Accenture even clears. Once that transaction closes, Ziff Davis will essentially have negative net debt. They're going to be swimming in deployable capital, meaning pure available cash they can freely use to invest, acquire new companies, or return directly to their shareholders.
Finally, Section 5, the Wall Street Forecast.
Analysts tracking Ziff Davis have been closely modeling this pivot. Across 6 major analysts, the current average price target sits at $48.67. The most conservative analyst sees it dropping to $30, perhaps fearing the slight revenue dip we saw in Q1, but the most bullish analyst models a high target of $61 per share, which represents a massive upside from where the stock has been trading.
And when you aggregate all those opinions, the overall consensus rating remains a solid buy. With an average one-year forecasted upside of over 6%, it is pretty clear that Wall Street generally approves of Vivek Shah's strategy. The market understands that while Q1 showed a little top-line friction, trading the connectivity division for a $1.2 billion cash pile is a massive net positive for the company's long-term flexibility and overall growth potential.
Which leaves us with the most exciting question of all. Once the ink dries on that Accenture deal, Ziff Davis will be a leaner, highly focused digital media company holding one of the largest cash reserves in its entire sector. They've explicitly stated they're exploring additional value-creating transactions. So, with a narrower focus and a massive $1.2 billion cash infusion on the horizon, what will Ziff Davis acquire next? Are they going to double down on health and wellness, maybe buy up more gaming properties, or issue a massive special dividend? Whatever they choose, it's going to send shockwaves through the industry for sure. Keep your eyes on this space. Thanks for joining me on this explainer, and keep learning.